Okay, and we're live. All right, so just start this off by kind of just giving a quick refresh on last week. I mean, we started off really hot last week, and then obviously Friday that was a huge red day. It was like a 5% day down in the indices, so not a great start to the weekend, but I think we'd all agree that we're still in a really strong bull market here. So it's just about keeping our wits about us here, not getting too emotional when we see some red in our ports. I think just in general, kind of the way I think about days like Friday, or when the red days really start and we get down to 2.5-3%. That's when a lot of people start to get hit with the margin calls. That's when a lot of leverage starts to get degrossed and people are like forced to sell essentially, which kind of just, it's this negative feedback loop that just feeds back into itself. So then we just get accelerated down all day. Like everything, it doesn't matter how strong a name is, it doesn't matter how good the story is about it. It's just indiscriminate selling. Like everything in my watch list anyways just got destroyed. Like everything's down almost 10%. So yeah, it's just important to keep that in mind, that like, no, this isn't the end of the bull market. This isn't, anything to get panicked about and, I need to sell everything and just get out of the market because this is the top. I think there's a bit of, deleveraging. I think people got a little bit excited when they saw the jobs numbers, but I think that a lot of those jobs honestly were from just like this World Cup thing with FIFA. Like a lot of these people probably getting like service staff getting hired and stuff for that event. So I think it came in stronger than normal, but I think the next jobs report, we're going to see it fall back in line with the trend and everyone's going to, be relieved again. And then instead of it being a rate hike coming later this year, it'll be, AI is taking all the jobs again. So we'll just bounce back and forth between those two narratives until probably the end of this bull market. And one of them prevails. Yeah, VIX got super jumpy there too, so just want to take a look at that. There's, every time VIX has a big jump like this, it can get a little bit scary. So something I'm going to be watching for is this coming off into the end of the week. Hopefully start to see people selling volatility again. I mean, like we just in like kind of the last hour, we had some news out of Iran with Trump telling Bibi not to bomb Iran and that they're trying to get a deal through. So I don't know what'll happen there, but hopefully, hopefully that gets figured out soon for everybody's sake. But yeah, so I'll just be watching VIX a little bit here into the end of the week. I think at the beginning of the week, we could probably see it's still in this range, kind of depending on the news we get, if we get any overnight here. But yeah, I'm seeing lots of people call for like a gap down on Monday, and then that'd be like really bullish. Like I don't really pay too much attention to those kinds of narratives. We just kind of, we have our underlying thesis here. Whatever the market opens at any given day shouldn't change your mind on the overall trend. In my opinion, the overall trend is still up. So, I mean, if we open up tomorrow, if we open down tomorrow, it doesn't really matter. Let's just pay attention to weekly candles, pay attention to volatility, and keep our wits about us as always. But yeah, this should be a huge week. I think this is the first FOMC meeting that'll be with the new Fed chair, Kevin Warsh. So we'll see what happens there. I know a lot of people are kind of thinking there may be some volatility into that meeting or coming out of it. So just keep that in the back of your mind. We also have a big IPO with SpaceX coming on Thursday. So, which is honestly kind of why I thought we were a bit red from Wednesday on last week as well. Is, a lot of people were going on CNBC or even just when I'm scrolling X talking about how they're kind of deleveraging their portfolios to create space so they can buy these new IPOs on these mega caps like SpaceX and Anthropic and OpenAI whenever those two eventually do go public later in the year. So again, like I wouldn't pay too much attention. If we have a week or two of chop, like that is not indicative of a bear market coming in the short term. So yeah, I'm still obviously bullish here. It was a tough day for all of us, I'm sure. Like my portfolio was down quite a bit. But yeah, I think that's kind of all I want to discuss regarding like last week and whatnot. So there's a lot of questions. You guys had a lot of awesome questions. I hope I can get all of them answered for you guys. And obviously, like I said, if I miss something or if you want to add on and kind of have a follow-up question, like by all means send it and I will get to it at the end. But I'm going to start here with John's question. He asked, if someone is starting a brand new portfolio with $100,000, what advice would you give that person on how to allocate it into the market? Okay, well, first thing I tell them to do is to join the Foundry. But then after that, I tell them to never make any investment or trading decisions out of FOMO. Like, you never ever want to be trading either on tilt or on out of FOMO. Those two emotions are probably the single greatest reasons for people blowing up, in my opinion. It's not because you don't know TA. It's not because it could be because you bought a shitco, but usually you learn pretty quick and you stop doing that after you get burned a few times buying a shitco. Typically, people and traders alike, especially even not novice traders, like even, decently adept traders, they let their emotions get the best of them. So I would say if you're starting a new portfolio, don't do that. Don't chase don't be chasing breakouts on a shitco with your entire portfolio. Don't blindly tail call flow. And when I say don't chase breakouts, I think breakouts are okay to trade if you're in a really strong bull market, but the whole point of kind of building your equity curve is to have a cushion right at the beginning, is to hopefully get a really, really good entry into something where it's a low risk entry. You're either entering right at major support or another level where you feel very confident and it's very easy to know kind of where your stop is, and you have the odds kind of stacked in your favor, right? So, don't be throwing on too much risk here without enough confluence and without enough support for that decision. You typically don't get these cushions by chasing, right? It's like any of the major winners I've had this year, from Lumentum to AMD to SanDisk to Micron, I wasn't chasing when I entered any of these names. All right, I was buying them when they started an uptrend and when they started to consolidate after their first leg up. I didn't catch any of these. I mean, except I guess AMD, I was buying that around 190, 195. But it was trading at 190, 195 while the market was down 10%, right? That was a very, very big clue. AMD was just going sideways, right? So you want to stack these things in your favor when you're starting a new account, because I've gotten blown up so many times in the past. And whenever I would start a new trading account and I'd finally save up 5 or 10 grand again and be ready to get back into the market, I'd take a trade and I'd immediately take a loss, and I would see that negative red number in my portfolio. I'd see that minus 10%, minus 20%, and this is just my own thinking. I don't know if other people agree with me, but when I see that number, I'm immediately revenge trading. I'm immediately trying to make that money back, because I hate seeing that red number, and the whole point of me trading is to make money. So if I'm not making money, then what's the point? So I know it's a really bad way to think, but that's how I used to think, and it obviously didn't work out well for me as I kept getting blown up. So yeah, you really want to focus on making your first few moves with your new account count, and by getting really good entries on names that you've not only done your due diligence on, but that the market is still willing to reward, right? Like, I would not be bottom fishing with a brand new account. I think you have to earn the right to, bottom fish and to scrape. There's a reason why stocks are down a lot, and there's a reason why stocks are up a lot. It's because the stocks that are up a lot, there's more buyers than sellers, and the stocks that are down a lot, there's more sellers than buyers, right? People want to own what's strong. They don't want to own what's weak, and neither should you. But yeah, I have a few more things I want to mention on that, because I thought this was such a good question, because there are lots of people who even just joining our group who may be just getting into trading or starting a new account. And obviously you want to get started on the right foot. But I would say I mentioned due diligence a little bit. I would say that I would say for sure that you want to understand what you're buying, why you're buying it, um, and then even deeper than that, you want to look at themes and the names in the themes, right? So AI is obviously like the theme right now, right? Like there are past themes from like 2020 with like weed stocks, or even recently with drones. That was a big theme, or nuclear. There's always a theme in the market that's strong. There's all, whether it's oil or AI or big tech. Like Mag 7 carried the market out of 2022, out of the bottom there, for like a solid 12 months at least, before other things started to finally be strong. Um, but yeah, you want to understand what you're buying, why you're buying it, why the market's rewarding it. Um, is the market thinking that their earnings are going to continue to grow? Are their earnings going to accelerate? Right. Um, for a lot of names that we're in right now, just personally, like almost everything I'm in, other than a couple like more speculative stuff like ASTS and Iron, that are in like super early growth, high capex phases, all earnings are like very, very strong. They're inflecting upwards, or they've already inflected upwards like crazy, and they're getting crazy multiples. Like if you look at Lumentum, it's got like almost like a 200 price to earnings, because everybody knows that by like 2028 they're going to be printing a lot. They're going to be printing a lot of money. I'm going to go more into Lumentum specifically later, because there's a few questions on that. But yeah, I mean, you just want to be in names that are obviously strong, and you're not bottom fishing. I think that's a big, big thing for this, for starting a new account, or for just getting into investing or trading. Um, yeah, I hope that answered your question, John. But like I said, if there's anything else that I missed, or that you, like I said, want to add on to, feel free to message, and I will get to it after. So there was another question here. It was, I believe it was from Joey. How do you maintain a watch list and stay organized? So that's another good question. So for me personally, I follow markets and names that I'm interested in, right? There's so many stocks to trade out there. There's hundreds, if not there's thousands. I mean, if you go all the way down to like names that we've never heard of, but there are thousands of companies out there, thousands of individual stocks that you can trade. That's a lot of work to track everything, and to try and be in every move before it happens, or right when it happens. And I don't have the capacity to do that. I don't think most people have the capacity to do that. Even if you were a full-time trader, it's hard enough to watch your own watch list, never mind the entire market. So I really focus on things I'm interested in. I focus on themes that I can see getting hot, and from there, I pretty much only watch those charts day to day, and especially intraday. Like for example, with Mag 7 and SPY, I check those once a day if I'm not in any of them. Usually at the end of the day, like I couldn't care less if Nvidia's down like 2% or Microsoft's up 2%. Like if I'm not in it, I'm not really watching it. I have enough stuff on my plate where I don't want to be taking my focus away from my own positions that I'm currently in, or the names that I'm trying to actively get into. If I have no plan to get into it, it's not on my watch list. I also think that it helps if you kind of nerd out a little bit, and if you're able to get really into these companies that you have on your watch list. You listen to all their past earnings report. You kind of develop a bit of rapport with their management, in the sense that you kind of understand what direction they want to take the company, and it makes it a lot easier to build that conviction for when it is time to buy. And you can buy it on a day like Friday and not feel scared about it. I didn't feel worried at all about any of my buys, about buying SanDisk or Lumentum or Micron or Sienna. Like I'm not worried. I'm not stressed about any of those buys. Did I buy the bottom? I don't know. But I bought somewhere that I'm comfortable owning those businesses. So yeah, just having a watch list. And another thing too, if you're not able to be on the screens all day, I like to use TradingView to set alerts at areas where I think a stock is likely to find support, or where an area maybe that I've added in the past and I have a nice cushion on. I'll just set an alert around there. That's something I do, so I can continue building my position out. That's what I did with AMD. There was like 5 separate days that I bought it, and it was all within 1% of each other. And I'm glad I bought it all those days, because now I got a huge AMD position, and we have a huge cushion if you guys tailed me on that play. But yeah, my watch list. Sorry, I got a little sidetracked there. My watch list is usually around 10 to 20 names, and those are outside of the names that I own. At most, like lately, I've only had about 10 names on my watch list, like outside of the positions that I'm currently managing, and I'm usually just kind of watching those names for sentiment, for continued strength or whatever, right? But I already have a pretty full book, so I'm not actively looking to trade anything outside of that right now. But there's been a few names that I missed, like Dell. Like even like I was in A-Lab a long time ago, but like A-Lab has ran a lot, Credo has ran a lot. These names have been super strong, and they're on my watch list, but yeah, I'm not actively trading any of them. And yeah, it's really good to remember too. I wrote this little quick note here down. It's really good to remember that good trading and good investing is boring, and it should be boring. And there's a reason for that. It's because you don't want to be mashing buttons all day, every day, right? Like, that is extremely messy. That just, unless you're like a 0-day spy demon, you shouldn't be making trades and, micro adjusting every single day. I think that really good investing and really good trading, you're waiting a lot of the time. You're waiting for a stock to come to you. You're not chasing it. You're waiting for good entries. You're waiting for trends to flip, right? Like if you're in a name like in SanDisk, I've had no reason to sell SanDisk since I got in last year, right? It hasn't broken the 50-day. It's just been so strong nonstop, and nothing about the narrative has changed. Nothing about the fundamentals have changed. Everything's accelerated, right? So, just being patient, right? Like I've barely even trimmed SanDisk, to be honest with you guys. Haven't had a reason to. So hopefully that answered your question, Joey. Just keep your watch list tight on things you were actually interested in, things you actually want to trade and want to get into. Don't overcrowd it with just everything that the market, that's in the market, from like Hood to Amazon to, I don't know, CrowdStrike. You know what I mean? There's just so many names out there that if you're not actively trying to get into them, I wouldn't really be watching them too closely. Personally, that's for me. Okay, got another question here. Do you recommend hedges to protect from downside on days like today and Friday? Well, hedges are something I've tried playing around with here and there. Whether it's put buying or call selling. And I'm not faulting anyone for doing them. I think that there's definitely a place for them, especially if you run a big enough book. I think hedges do make sense. But I feel like hedging is almost something you earn. I think it kind of goes back to what I was just saying about like button mashing all day. Like just because we've gone up a lot, like imagine, we're here and you're loading hedges because we've gone up in a straight line too much, and then we just never drop, and then we just keep going. And then you think, oh, here, okay, yeah, we gone up like 25% off the lows now. Now it's time to hedge. And I used to do this a lot, so this is just me talking from my experience. I found, honestly, more often than not, my hedges were just basically getting faded, decayed to zero, and I wasn't actually making money on them. And when I was finally right, it was such a small amount that it never really made a difference anyways, and I would have rather had that cash freed up to buy my favorite stocks. So just from my years of trading, that's something that I've more adjusted to my own liking, and that's just not being too heavy into the hedges. But like I said, there's nothing wrong with them. I think if you're running a book that's let's say like you're running a trading account that's $25,000 or $50,000, like how much of that do you think even makes sense to hedge like your portfolio if you have, because just by definition a hedge means that you don't know the timing, right? You're buying insurance just in case, right? I feel like it's not as value accretive to be hedging as it is to be looking for opportunities to get long with conviction and with size, especially in a strong bull market. I know a few of you out there definitely agree with me. So what I've been doing is just cashing up on big moves. You know, when you go up a lot in a short time, or a thesis is played out and you've executed a good trade, take the profits and just chill. Wait for a good entry. Like I said, good investing, good trading is really boring, right? You let stuff come to you. And in like a really strong bull market, I think I think hedging is, if it's cheap, if VIX is super low and you can buy cheap insurance, I don't think there's anything wrong with that. You know, I've been saying that and I'll say it again. There's nothing wrong with it. Just my own personal preference. I'd rather have that cash ready so I can get long, because overall I think the market's heading higher, and I think that my money serves me best in getting long the strongest names in the market. And yeah, it's just like just doing the math even, right? What a hedge would pay you, even if you're right, is nothing compared to what a good long entry with high conviction and good sizing will pay you during a bull market if you're right. It's not even close, right? Just like I said, by definition, with a hedge, you're doing what? Maybe 1% of your portfolio into a hedge. No one's putting 25% of their portfolio into a hedge. That doesn't make any sense, right? But you might put 25% of your portfolio into a long, and it might, quadruple in 6 months, like Micron or something, right? So yeah, those are my thoughts on hedging. Personally, I don't think that this is the market right now to be too worried about hedging. I think that we're in such a strong bull market. I think your money will do more for you on the long side, in my opinion. Yeah, especially if you're trying to build your equity curve. Every single dollar counts, All right. Let's see what we got next here. At what point do deteriorating fundamentals make you exit a stock? Well, okay. This is a really good question. If the fundamentals were part of my underlying thesis and they're deteriorating, I'm exiting. And like what I mean by that is, if I'm entering a name and I think that this name's gonna, I don't know, gonna post really great earnings for the next 8 quarters in a row, and I think that they've got a new product ramp launching, and they have tons of orders, they're sold out, and then their earnings call comes and they miss and they guide lower because of whatever reason. Maybe they lost design to their competitors, or whatever market conditions happened. I don't know. I'm you know what I mean, though. The point I'm trying to make is if I entered that name, and if I entered that trade with this thesis in my head based on their fundamentals, and they obviously shown that they're deteriorating, I'm getting out of it. Another, actually a really good example of this is when I entered A-Lab. Okay, I entered A-Lab because they were posting strong earnings for like 3 quarters in a row that I was watching them, and I was like, okay, I'm going to get in here. I think that their earnings are going to continue to be strong. And I think that, obviously my thesis was that I could make a lot of money on that trade, right? But I was buying A-Lab while it was already extremely richly priced. Go look at it now. Yeah, it's just been so strong out of the lows here. But I was buying A-Lab when it was trading at like a PE of like 450, and that's okay. Okay, like PEs aren't super critical in a bull market, but A-Lab's earnings were slowing down, and when your earnings start to slow down, which it's just the law of physics. That's why Nvidia isn't posting like $20 trillion quarters, right? Because they just can't keep earning at the same growth rate as they did initially when they first started selling GPUs, right? When your earnings start to slow down, your multiple starts to compress. That's just the way the markets work, right? And that happened with A-Lab. They went from growing at like triple digits over year to maybe high double digits, right? And earnings started to compress. There's nothing wrong with the company, but what that means is the underlying thesis is being deteriorated because the market's starting to view them differently. And if you don't get a good entry, you don't get a good cushion, unfortunately, it's very difficult to sit in those trades during multiple compression, right? Because that happens over quarters. And if you're in options especially, you don't have time on your side when things trade sideways for quarters. Like ALAB traded sideways for 2.5 quarters, right? Like that's a lot of time off your options. So yeah, that was an example of when fundamentals started to deteriorate with ALAB and when I should have exited. Another one was Credo. I was in Credo, right? And Credo, they're the purple cable company. They do the active electrical cables inside data centers. They were super super hot for a very long time, really really strong, right? But the issue with Credo is not even the issue with Credo. The market started to shift a different direction. Okay, the market started to be focused on photonics, and obviously you guys know that as we're in light, we're in AOI, coherent, blah blah blah, and the market stopped viewing Credo's moat on active electrical cables as something that should trade with an insanely high multiple. So what happened was Credo got sold, and even if it got sold a little bit too low, like I think 87 was that's just way too low for Credo. But even if it got sold, I'm just one guy in a stock. I can have a thesis all I want. At the end of the day, I'm trying to make money. I don't I'm not trying to be right. I'm trying to make money. And if you're trying to make money when the market tells you you're wrong, you just have to accept it. It sucks. Losing money is never fun, but you lose a lot less money by being able to accept that fact right away rather than fighting it the whole way down. So I closed this trade. I saw the writing on the wall too, and I reacted a little bit too slowly for my liking. So there's a lesson in there for me for sure. I should have cut Credo much sooner than I did. But the market's always forward looking, and it was, photonics were all the rage, optics were all the rage, and unfortunately that's anti-copper, right? So yeah, if the fundamentals like that start deteriorating, then yes, I'm definitely an advocate for cutting those types of trades. How much weight do you give management guidance versus analyst consensus estimates, and how do you spot when management is sandbagging versus genuinely cautious? Okay, another great question. So this one's a little bit more difficult to answer. I would say that a lot of it is you almost get to know the company and management by listening to the way they speak on their earnings calls, the way they speak at conferences, and just by following price action, following the business as a whole, right? Like seeing when they win specific designs, when they get deals, when they get certain partnerships, and kind of being able to have a good sense of pattern recognition. Yeah, you get a feel for that by following them for a long time. There's no way I could just open up a random company like, I don't follow Vertiv as closely anymore as I'm not in it anymore. I can't just listen to the Vertiv CEO speak and give like extremely cautious guidance on something and say, oh yeah, he's definitely 100% sandbagging. Like for sure, like you got a long this year. I can't do that. I haven't been following, right? Of course, it's a pretty safe bet given their market positioning, given the strength of AI that, there's a good chance that they could be sandbagging. But you get that feeling from just being in these names and from following these companies for a very long time and genuinely taking an interest in these names and building that conviction. You're able to kind of see the writing on the wall. Like for example, Teradyne there. Like I knew before they reported this quarter that they were going to drop because they were going to sandbag. I put a post on it like a month before this quarter that was going to happen, and it did happen. And the reason I knew that was going to happen is because I was listening to the CEO speak at conferences. I was listening to earnings calls, and he mentioned multiple times that their earnings were going to get a little bit, and I quote, lumpy because of different customers ramping their product cycles at different times. So I knew that was going to be a great buying opportunity, and it was. Like we bought calls on this day, and the calls were up over 200%. It was a great trade for anybody who tailed me. And you kind of earn the right to take those trades, right? Like buying a huge gap down. Typically, I would say 99.999% of any technical analyst people would say never ever do that. That's like breaking a cardinal rule. But these names that are in such strong areas of the market like semiconductor testing, or even like Ciena, right, with their optics and their fiber stuff and their products for scale out with data centers and connecting data center clusters and all of that type of stuff. They're in such strong like ends of the market and addressing such important problems for their customers that drops like this typically get soaked on really, really strong names. You'll only ever see it drop and continue going down if the market's truly out, like, and I quote, out on that name for at least the short term, right? But it's worth a stab, in my opinion, getting long on these drops on really, really strong companies. Like, the same thing happened with Micron. Their last report, they just started dropping, and then it was kind of just volume decelerating as they dropped, and then volume picked up right at the bottom, super crazy, and that's when we started loading calls on Micron. And yeah, it was a great trade. I mean, we made hundreds of percents on that. So yeah. Anyways, I got a little bit sidetracked there, just going through when you're able to kind of take advantage of sandbagging, but yeah, I would say the best way to answer that is you genuinely have to be following the company and following what management is saying to be able to tell when they're sandbagging. Yeah, I can't just open a random earnings call and say, yeah, he's sandbagging, I'm buying this. Like, I have no conviction in that trade. I wouldn't be able to do that. I think another really good way to kind of not even tell they're sandbagging, but feel confident buying a drop after earnings or any weakness that comes after is by just looking at the overall market trend. We know AI is such a huge trend right now. It's the trend, right? It's the reason why this bull market is where it's at, is because of the spending that's coming with AI, because of the earnings that are inflecting because of AI, right? If you're a great company and you're selling shovels during this AI gold rush, I think that any dips are typically getting soaked pretty quick, unless obviously there's something catastrophic that could happen. Like, I don't know, like I said, they lose a bunch of design wins, or they can't qualify for this, so their competitor just keeps eating their market share. Like, those are valid reasons to go down, even if you're an AI company, even if we're in a bull market, right? But if you crush earnings and you just didn't crush it enough, and the market wants to sell you off like Avgo for a couple days or a couple weeks, like, in my opinion, those are long-term buying opportunities. The tide is just, it's rising so fast that anything involved in AI is going to keep growing their earnings, because hyperscalers and other companies building out their infrastructure continue to increase their spending. And AI continues to become more and more useful, so that's why they're increasing their spending. It's just we're in this really, really amazing cycle right now where these companies that are spending a lot are seeing ROI, so they continue to spend more, so they get more ROI. And as an investor, that should make you really excited. It's super hard for me to be bearish right now when we have Google literally doing like equity raises and stuff to spend more on AI. Okay, I hope that answered your question. What is the best way to do research on a company? How do you go about it? AI prompts, listening to earnings calls, reading transcripts, reading research notes. I do all of that. I do all of those things. I listen to earnings calls first and foremost. I listen to any time that they have like a JP Morgan tech conference, Goldman Sachs, whatever, right? I listen to any time management is speaking. If they're doing interviews, I'm listening to what they're saying. I believe you genuinely have to be interested in the companies you own to build that conviction in order to be able to hold them through any sort of volatility. And the best way to do that is to really fully understand the company, first of all, and then second of all is to follow the company, right? Like, follow the management. What's management telling you? What are they signaling that is coming? And then from there, do your own research, right? Take notes on questions that analysts are asking about. They might be asking about new product ramps or something, right? Like, take notes on that. Go to AI and say, what can you tell me about this, right? Like get creative with your prompts. Like how does this new product compare to their past product, right? Like how much more margin are they getting on this new product? Like whatever questions you can think of, right? You have to be able to build your own models and to be able to kind of have a thesis that keeps you long during a bull market, during volatility that inevitably comes, like Friday, right? Like I didn't sell. I don't know about you guys. I didn't sell any of my positions on Friday. I mean, it sucked. Dropped a lot, but I just have so much conviction in the names that I'm in that I had no reason to sell anything. But yeah, I would say the best way to do research, honestly, is just everything that is given, like earnings calls, conferences. You need to listen to those. That's a bare minimum, and then from there, do your own research. Tanner does really good research on a lot of stuff. He's charted things from like the .com bubble and still has those charts annotated and stuff. Like whatever way helps you to do your research, I highly recommend that. For me, I like to listen to earnings calls. I like to do all that stuff. I like to go on AI. I like to ask a lot of questions. I like to really, really understand what I'm investing in and why this company deserves my money. And then from there, I just watch the charts and wait for a really good entry. Sometimes you get really late entries because of that. I did with SanDisk. Like I was watching SanDisk back like around here, I think in October, and I was doing research, and around here I was like set on buying it. I was like, okay, I need to buy it, and it just kept going, and I could just never get comfortable chasing this one and getting a good entry, so I waited, and then we dropped like 80 points. Was this like 280 to? We dropped like 100 points here, and not once did we break below the 50-day. So I started buying in this area. This is where I started buying SanDisk instead of back here, which I mean, I think it's Druckenmiller. He says buy now, research later, which honestly in a bull market I do agree with. Instead of just buying it back here at 170, I was able to still get in at a pretty good area here. My average on SanDisk shares is 185. So yeah, you gotta. I spent all this time here building my conviction, doing research, kind of building a thesis around memory and where I thought it was going to go, where I thought pricing was going to inflect, and then I went to the charts and got my entries, and it's been. Yeah, it's been a really fun ride since. What are your thoughts on Nokia right now? Let's go pull up Nokia's chart. Well, I mean, this chart is really strong. I mean, talk about like we were just looking at SanDisk chart. Like this is a super super strong chart. I think Nokia is still in a very very strong uptrend. I mean, we just closed below the 21, which for me, I don't really use EMAs as a hard stop in a strong bull trend. But yeah, I think that there's nothing wrong with Nokia. We saw tons of insider buying like you mentioned. I'm still long. I'm still holding my position. And if the market wants to give me a retest of the 50-day, I'll probably add to my position, honestly. I think Nokia's got a lot of things coming in the pipeline, and it wouldn't surprise me if they had a few major announcements before the end of the year. Whether it's a deeper partnership with NVIDIA or something that the market's building that we don't even know about yet that Nokia is a part of. Just the amount of buying and insider buying that I've been seeing and flow that I've been seeing is just ridiculous. It would not surprise me in the slightest if Nokia went on another, like if it kept this run from, what is that? Like from under $4 to like over $20-25. It would not surprise me in the slightest. So yeah, I'm still long Nokia. I still like Nokia a lot. Okay. Here's a really good question. I think David asked this. So say you're bullish on a specific theme. How do you determine conviction on one leading company versus another? For example, bullish co-packaged optics. What percent allocation light versus coherent? Bullish CPU. What percent Intel versus AMD? Bullish memory. What percent Micron versus SanDisk? Many such analogs, but curious what the research / thought process looks like, and how much technical / flow play a role versus fundamental differences like valuation, technology moat, etc. Yeah, okay, this is a really, really good question. So who do I want to talk about first here? I think I want to talk about SanDisk first. So let's have SanDisk chart in the background while I'm yapping to you guys. So yeah, this is a really good question. So I put more weight personally on market position, technology, their roadmap, moat, and like even things like honestly like the amount of shares outstanding. I look at all of those things. Than I do flow or TA. I think purely, I think trading purely technical analysis with no real fundamental understanding of how the business operates or why you'd expect this stock to rise is a little bit lazy trading, in my opinion. It might hurt some people's feelings. I don't care. It's the truth. I used to trade this way. I didn't even understand what a company did. I just looked at a chart and saw, oh, it looks good, and I would just blast 1 month out calls on it. I think that you really, really need to drill down on the fundamentals. If there's anything you guys learned from me, please let it be that you need to understand what this company does and you need to build your conviction so you're able to actually hold for big, big moves. Like there were so many times in this SanDisk trade where the noise on X was just unbearable. It was just, oh my god, memory's over, memory's top. Like SanDisk posted this candle here and then went red for like a week, and everyone was like, oh my god, it's over again. Tested the 50-day. The noise is just so loud, and you just have to be able to cut through that and rely on your intuition and your research and the conviction you've built to stay in these trades. I think that oh man, I have a lot to say on this. Actually, this is a really good question. Sorry, I was just rereading the question again. So I guess for SanDisk, like I can give some examples that I think that'll help. A super basic analogy for SanDisk is that they are selling shovels to the biggest companies in the world with the best balance sheets in the world during an AI gold rush, right? You literally you scientifically cannot, whatever word you want to use, you cannot scale AI models. You cannot have faster, better inference without more memory. It is impossible. It is not possible. You need more memory. That is just an indisputable fact, all right? Being able to identify that, I mean, obviously some people were able to identify this way back in August of last year. I mean, they're probably off grid now and have their own private island somewhere or something. But for me, even where I got in here, from the lows, it was 10x off the lows, and I was able to get a great entry on it, right? And I was only able to get this entry because I was able to build that conviction in this theme, right? They, like I said, they're selling shovels during an AI gold rush. And I'm not even necessarily like a semiconductor analyst or anything by any means, but I knew enough to figure out that as models, their context windows grew, the photo video generation became mainstream, or inference began to scale as as AI popularity and use cases grew, and that anything even touching memory was going to do extremely well. And unfortunately, I did enter STX last summer, and I paper handed that, and I learned a lot of lessons on that. Every time I look at the chart, it hurts, but I learned that lesson and I applied it to SanDisk. I applied it to Micron, and I haven't paper handed it since. It's been such an easy, fun hold, and I don't see us topping for memory at least anytime soon. From what I'm hearing, it doesn't sound like there's going to be enough supply to really offset demand until 2029. So I don't know why we would top in 2026. I feel like we're still going to have a pretty strong year here for Micron and SanDisk and STX and all the memory companies. So SanDisk, it was a pretty quick decision for me after doing a bit of DD that I needed to be in this stock. I also, when I was doing research on SanDisk, so I mentioned this very quickly earlier, but I really like the fact that they had a low float. Like they had a lot less shares outstanding than Micron. Like Micron has over 1 billion shares outstanding. I think SanDisk had at the time, I feel like they had under 200 million. But yeah, with less shares outstanding, you own more of the company when you buy shares. It has a higher ADR, right? The daily range moves way more, and big moves become really big moves because there's just not enough not enough sellers to keep up with the amount of demand that buyers have. So the stock price has nowhere to go but up. And I also liked that their CEO's compensation was tied like directly to SanDisk reaching certain milestones, which at the time when I bought back in November, those milestones just seemed so out of reach that I was like, okay, like the CEO doesn't get paid unless these things hit. I can afford to, try along here. It just added to my conviction. And I mean, it's obviously paid off, right? So another one I wanted to talk about too, so that's SanDisk just quickly, it was Lumentum. So for Lumentum, I sized up more into Lumentum than their peers like Coherent. And I'm still long Coherent. I still like Coherent. But I really sized up into Lumentum. That's kind of the one, the pony that or the horse that I chose to ride. Was because Lumentum has the best technology, in my opinion. Like Lumentum is the only supplier right now that's shipping 200 G per lane EMLs, which are electro-absorption modulated lasers at volume, which is the critical component for the next gen 1.6T pluggable transceivers. So you hear about co-packaged optics and the 1.6T transceivers all the time. Like even in NVIDIA earnings calls, they're talking about co-packaged optics and their future ramps. Like Lumentum is right at the center of that. Yeah, it's just I have a little bit more here on their notes here. So for their basically co-packaged optics in general, just for anybody who isn't familiar with it here, they demand an extraordinarily precise laser source. And as far as we know, Lumentum is the only company who has publicly shared their specs on their lasers. None of their competitors have shared their specs, and a lot of people that are semi-analysts have basically said that because none of them come close to Lumentum, they obviously don't want to share their specs. Lumentum's also much more of a pure play, in my opinion, than Coherent is for this optics / photonics trade. Coherent's really, they solve a lot of problems. I like I said, I'm still long Coherent. They're a great company, but they have a large percentage of their revenue still tied up with industrial applications and whatnot. I don't think that a majority of Coherent's revenue comes from data center. Not yet, anyways. I mean, will it inflect there? I'm sure it will. But as for a pure play, if you wanted to play optics, I think that Lumentum is the one. Also Lumentum is growing their operating margins at 12x the rate of Coherent. So hence the multiple, the difference in multiples. I think Coherent's trading at like I can check that super quickly here. But anyways, Coherent's trading at like a way lower multiple than Lumentum, and the reason why that is because Lumentum's growing way faster. Yeah, it's trading at almost half the multiple of Lumentum. Okay, I mean even then, trading at half the multiple of Lumentum, I think that Coherent's pretty richly priced, to be honest, because they're not growing nearly as fast as Lumentum is. And one more note on Lumentum, just because I love Lumentum so much. And this is one of those things that kind of ties back into one of the previous questions that was asked about how I do research. So I found this in my research, and I have it in my Lumentum notes here, is Lumentum's 200 G per lane EMLs ASP, so their average sale price, is double the ASP of their previous gen 100 gig per lane EML. But their cost of goods sold are only up 15% more between models. Okay, so just super quick. I'm not a CPA accountant, but anybody can surmise that they're going to be cranking cash out with this model. Their inputs have barely risen, but the cost has doubled. Right, it's just basic math here, basic accounting. They're going to be printing money like crazy, and I think right now they're only at like an $8 or $9 per year EPS range right now. My base case for Lumentum by 2028 is that they're going to be making around $60 of EPS. So obviously we'll see what happens. I might sound like a madman, basically calling for almost, what is that? 800% increase in 2 years. But I genuinely just have so much conviction, use that word a lot, conviction in this company, and I built it through hours and hours of research. And I think if you guys put that time into Lumentum, you guys would feel the exact same way as I do about them. Okay. I think I answered that one pretty good. Also, yeah, I love to just shout this one out because it's something that I love. Lumentum has a super small float too. They have under 100 million shares outstanding. So, yeah, any type of strength or big move on Lumentum, it moves that stock a lot, right? It's why like things like Amazon and like, I don't know, Nvidia are such slugs and they don't move very fast very often, is because their floats are so large. So like if you're moving 3% in a day on Nvidia or something, that is a big day for Nvidia. But Lumentum might trade $100 in a day, right? So yeah, that's something I love personally. Okay, moving on here, the next question. As your portfolio grows, do you think you'll naturally take less risk? Example, rely less on options, focus more on common shares. Given the combination of portfolio size and investment horizon, owning quality stocks and letting them compound should already put you on track for generational wealth. Does that change how aggressively you invest, or do you continue taking the same level of risk? So another great question, all right? For me personally, I do take less risk than I used to, for sure. I was probably running an 80% options, 20% equity port when my account was smaller. And yeah, that comes with a lot more volatility, but obviously a lot higher upside when you're right. And I think even a 50-50 port makes a lot of sense for a lot of people, because back then I was taking, like, if I would take a big loss, it would, in some cases, it would take me months to get back to where I was if I took a big loss on options, right? So I really had to learn how to trade options that work best for me. And right now, honestly, buying longer term options with higher delta is what works best for me. I used to be about the cheaper contracts, monthlies, and kind of, oh, it's breaking out, let me just buy like 50% out of the money calls like a month or two out. And for some reason I was surprised that my P&L curve wasn't growing. So yeah, but to answer your question more directly, as my portfolio has grown the last 12, 18, 24 months, I have shifted that a lot. I think right now, as of today, I am about 65% stock and 35% options. And my goal is to trend towards an 80-20 split, because I think no matter where I am in life, I'm going to still trade options. I really enjoy trading options. It's just fun for me, and I like doing it. So that's why I do it, right? Whether it's, playing defense and collecting premium, or selling puts on names that I really want to own, and kind of having it in my head that, oh, the market's going to pay me to own this stock. I love that side of trading. I love the freedom that comes with trading, and trading options definitely adds to that freedom. So yeah, for now, I'm definitely focused on lowering my risk, and I think by the end of this year, I'll probably be around a 70-30 to 75-25 split, ideally, and yeah. Okay, I think those are all the questions that I wrote down. Let me check if you guys have some questions in here. Oh yeah, that's a great suggestion, Tanner. Yeah, Tanner said underrated research is to listen to their earnings call when the price was the lowest in the last few years. That's actually insanely smart, because you're listening to what management is guiding for when the market basically doesn't see the value in that company at that moment, and you're kind of able to build some sort of rapport with management where you either, it gives you trust in them, I guess. If they're saying, oh, we're expecting this to rise by next year, blah, 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 and that's their absolute low of the year, is that earnings report. And then you go back and you say, oh my God, how was I so dumb? Why wasn't I early enough? Well, you weren't listening to the earnings report when the market disagreed, right? Yeah, I think that's a really good strategy. It's just hard to do that right now because all the stocks I'm in are nowhere near lows, and we're in such a strong AI bull market that probably won't get that opportunity in stocks I like anyways until the market's done. But yeah, I think those are all the questions that I had, guys, from you guys. You guys asked a lot of really good questions here. But if there's anything you guys want to send in the chat here, I'm I'm here, you know. I'm here for you guys. I want to answer all your guys' questions. I want everyone to get the most value out of this as possible. And I don't know if you want to come on and say anything, Tanner, but you can if you want to. If there's anything you want to talk about, that's more than okay. But yeah, I'm looking forward to a good week this week. I think the SpaceX IPO will be super exciting, especially for us retail investors. Hey, what's up, Tanner?